Hi, everyone. My name is Mario Tridia. I'm the Senior Wealth Advisor with SRP. I'm joined here with Bob Wagner, our Chief Investment Officer. And just wanted to give you all an update on what happened within the second quarter, as well as just an outlook for the next quarter coming due, as well as the rest of the year. So, Bob, I know you and I talk weekly and look at our portfolios. I think the key theme here, it's really the 180 that's happened from last year to this year. Specifically, what's happening on the growth side of the market and within the portfolio, which impacts things like the S&P 500 index too. And the key thing here as well, it's been things like bonds, where you look at 2022, no matter where you are in the market, you pretty much are down, except for a few sectors. And right now, I think Bob, you mentioned this to me, it's a mirror image of itself, looking at just how things reversed.
Yeah, this has been a very fascinating year for multiple reasons. One of them is growth did extremely well during a period of rising interest rates and talk of a recession. Normally, you don't see that. Normally, you see the exact opposite. And so what we had last year was an extremely bad year. We're getting a bounce off that, but it was really surprising to see the sectors that did well this year doing how well they did do, given the market conditions and the conditions of the economy.
Yeah, I think, Bob, that's a good point. Looking at just what are the key themes that we have just for last quarter of this year, as well as the rest of the year. And I mean, the talk of the news is what's happening with the Fed and the central bank. I mean, inflation is coming down, the measure that they're looking at. There's been 11 rate hikes since 2022. So to your point, just a big shock to the market. And there might be talks of even a rate cut next year. And then even so, we'll dive into a lot of the conversations I'm having with clients. It's when you look at the market, I'm doing quotation marks on that. It's people look at things like the S&P 500 index or the Russell. And the one thing that I have to explain to clients, it's kind of how are those indices made up? And just kind of surprising how a few companies control so much of the index. And then I know you and I have been talking about the bond side of the portfolio and how we've been really short duration, short-term bonds, mainly U.S. Treasuries. But we're looking at things like maybe corporates, given the yields that those things might have with the spreads.
Yeah, and we also have a barbell in that fixed income portfolio. We do have corporates out on the longer end, but we also have a huge amount of the short-term part of the portfolio is invested in treasuries. The reason we're doing that is because the interest rates are so attractive there. We're getting substantially more in treasuries on the short end than you get on the bonds further out on the yield curve because of the inversion. This is if you take a look at what's going on in the economy, this is just simply a very different type of a market, because you hear them talking about recession. Normally, you don't hear talk of a recession when you have such low unemployment. Normally, you don't hear talk of a recession when you have inflation. Inflation is normally an overheating economy, not one that's slowing. So there's a whole, and there's a labor shortage out there. So there's a whole slew of cross currents out there that are making it very difficult to understand what's really going on inside the market and where we're headed.
Right. And I love that you mentioned the market, because one thing that I love and just what surprises me is what is the market. So I mentioned before, these are the top two indices that most people look at, most investors look at. These are things that you and I look at. And what's surprising is things like the S&P 500 index, which represents the U.S. market. It's an index that encompasses 500 companies, but it's what's called a market cap index, right? Meaning the bigger you are as a company, the more weight you have in that indice. So even though there's 500 companies, the top 10 companies here, Apple, Microsoft, Amazon, heavy tech companies, I mean, these 10 alone represent almost 31% of the index. So to your point, things like growth have been doing so well for the year, which means that these tech-heavy companies are pulling more of the index up, which is why we're seeing the U.S. and the large cap growth index up the way it is.
Yeah, and even the S&P 500 is considered a blend index because of this expansion of the capitalization. It skews the index towards being growth, and as you can see, there's a tremendous amount of overlap between the growth index and just the S&P 500. Up and through, we have another slide where up and through the end of May, those stocks were responsible for 100% of the gains in the market. Since then, things have begun to diverge a little bit, but those stocks have been the powerhouse behind the drive in the markets this year.
Right. I think that's one of the reasons why we went more to our neutral portfolio between growth and value, just given how well these companies have done, and it has helped our clients too. But you brought up as well the barbell approach that we have with our clients' monies on the bond side. And to your point, this is the reason why short-term bonds, things that have less than 2 years of maturity, I mean, you're getting over 5% of a yield on those things. And we have an inversion, meaning longer-term bonds are paying less interest than shorter-term bonds. So this is why we have this what's called barbell approach, right? Having short-term bonds, given the interest rate you're getting, and then having longer-term bonds or intermediate term, just as a recession hedge for that aspect.
Yeah, by keeping it short, we don't have any interest rate risk. Interest rates can do whatever they want, and they're not going to really hurt that. The other thing that we're doing is the short-term holdings that we have all treasuries, so we don't have default risk. On the other end of the barbell, we do have some credit risk, and we do have some interest rate risk because we're longer out on the duration. So by that way, we're if the rates continue going higher on the short end, we're going to do well because our short-term instrument will benefit from that. If rates start to go, like if there is more talk of a soft recession, soft landing, the long end may start to come down. That's where our longer-term holding will do well because both the corporates will do well there and the treasuries as the interest rates fall and as the economy improves. So we've got it. We're in a situation where we don't have a great deal of confidence on one way or the other where we're headed. So we just do a barbell to make sure we're covered on either side.
Yeah, and I think too, Bob, the one thing that you and I are looking at for the portfolio, not a decision yet, but it's looking outside of traditional treasuries, just given things like corporate bonds. So I know one of the risks that we have to look into here is a recession and how corporates would do in a recession. But the big surprise here is what's called the spread, meaning the difference between a treasury bond and an investment grade bond. And they look really attractive, but the thing we have to take into account, to your point, it's interest rates keep going up that will affect longer term bonds. And then as well as this thing called a recession, if that were to happen.
Yeah. Now once again we do have some credit exposure in the long end of the barbell. What we were probably looking at is buying more short-term corporates, and you can kind of see there's a little blip there on that chart that shows you that those yields are pretty attractive. But once again, by doing that, if we roll into a recession, we'll be punished for that. So we're a little careful there, just because our bond portfolio is doing so well. And I'm really comfortable with the positioning. We've got that barbell. We're covered on if rates keep going higher, we're covered. If rates start going down, we're covered. So,
right. Well, with that, I want to thank you all for taking time to just listen to Bob and myself. And Bob, I appreciate you joining on here too. If any of you have any questions, please reach out to one of us at SRP or your local wealth advisor. Enjoy the rest of your summer, and we'll look at you next quarter. Take care, everybody. Thanks, Bob.